All right, welcome back to second lesson of the box system. In this lesson, we will discuss indicators and the different types of boxes you can expect to see in the markets. Let's continue with the example we picked up in the first video of Roku. And as I mentioned, it was a beautiful trend that developed in 2020, and it had all kinds of boxes that I would like to show. So let's start with it. First things, let's discuss the indicators. The two main indicators that I use are the 9-day moving average and the 50 moving average. You can use simple moving average, you can use exponential moving average, you can use weighted exponential moving average. It doesn't matter. They all are similar. Besides, indicators are exactly that. They're hints for decision making. They are not foolproof methods. I use simple moving averages, the 9 and the 50. You have to realize that markets are fractals. What happens on one time frame is similar to what happens on the other time frames. You will see the patterns that develop on weekly, they will develop on daily, they will develop on hourly. Maybe not in the minute or seconds because that's too much noise, but for the most part on higher time frames, the markets are fractals. So these 9 moving average and 50 moving average will be important on all time frames. I use them as such. The 9 moving average is my short-term momentum filter, and the 50 moving average is my medium-term momentum filter. If the price is above the 9 moving average, it's likely to keep going. It's likely that it has high momentum right now, and it should move fast and move higher fast. If the price falls below the 9 moving average, that means the short-term momentum is dying down, in which case it might need to chop around for a bit, consolidate again, and then go higher, or it recovers the 9-day moving average within a day or two, and in that case we are off again. So that's how I use them as filters. How do I use the 50 moving average as a filter? It's my medium term momentum filter, so I only take box breakouts long if the price is above the 50 moving average. The same way, I only take breakouts short from a box if the price is below the 50 moving average, because it describes the medium term momentum. So we don't want to take a breakout that's against the 50 moving average, because the price might face some resistance when it touches it, and that will lead to a failure of the breakout, and that's a very high likelihood, so I do not take those trends. Once you know how I use the 9 and 50 moving averages, let's look at the different kinds of boxes, and you will understand why I picked these two. Alright, so let's take Roku as the first example. You will see this massive box. Alright, let's begin with this. There are 3 types of boxes that I look at. One is this, a base box. A base box develops over a few weeks to a few months. Sometimes it's over years. That's a box developing on a weekly or a monthly time frame instead of a daily time frame. But base boxes can develop for a long time. If you want to see a base box that developed over a long period of time, look at gold from 2011 to 2018. That box developed over 7 years, and then the breakout happened and gold moved up fast and everyone was surprised. Why are you surprised? The price was consolidating in a region for 7 years. That's a lot of energy. That energy needs to be released. The price has to start moving. You can start thinking of price within these boxes as a coiled spring. The more it consolidates, the more energy it collects. So the bigger the box, the bigger the breakout will be. The longer the price will run because it has more energy. Alright, so this box developed over months. That's a base box. You see, from these comes out the most beautiful trends that run for a long time. Once the price starts trending, we saw the trend structure in the last video. The price ran, then the trend structure broke down, and then it had to consolidate again. we were in a non-trending phase. So what usually happens after a base box is once the price breaks the trend structure, it starts consolidating again. It waits for the 50 MA to come and push it higher. That's what I have seen. You will see the 50 MA on the daily corresponds approximately to 9 MA on the weekly. So what you are actually seeing here is the 9 MA on the weekly pushing the price higher. So the second type of boxes which we usually see are 50 MA boxes. That's 50 MA on the daily. That's the one pushing the price higher. So it's consolidation, waiting for the 50 MA to come up, and boom, we go higher. So that's the second type of boxes. The first one, base box. The second one, 50 MA box. The third one, which are the smallest and do not trend for that long because as I said, smaller the boxes, the smaller the trend, are 9 MA boxes. You see them all the time. They are 3 or 4 days of consolidation where there can be a small pullback or just sideways consolidation and the price breaks higher. In this case, you will see here for 4 days in this small box up here, for 4 days the price is just moving sideways and then breaks out higher. These moves are usually quick, 1, 2 days, maybe 3, and then they die down. So that's the third type of boxes. You can call it a flag, you can call it a 9 MA box, whatever you like. Another one would be here. You see the price went higher quickly, so it moved sideways for the 9 MA to catch up, and then it went higher. Sometimes it's a flag. The price went high quickly, then it came slightly lower to touch the 9 MA, consolidated before it went higher. So that's the third type of box. It's a 9 MA box or a bullish flag, whatever you want to call it. So the three types of box we saw are the 50 MA box, the base box, and the 9 MA box. The most reliable ones in the breakout scenario are the 50 MA box. The problem with base boxes is sometimes the price can go out for a little bit, come back and keep chopping. But for 50 MA boxes, the first 50 MA box after a breakout, that's extremely reliable. The price just goes, as you can see in this Roku example. Another interesting case would be to look at Google. It has had 50 MA box after 50 MA box all of last year and this year, and that's what the price has been doing. I will draw some so you can get an idea. Okay, I don't know why the TradingView is not letting me draw a box, but you can see between 1806 and 1700, you see a box here. It broke out. Then you see another box, broke out. All of these are 50 MA boxes. You see the 50 MA pushing the price higher? Google has done that all last year and this year. It's just 50 MA box after 50 MA box. Another one here, 2204 to 2400. Price went higher, retested it, boom. So now that we know the indicators I use and we know the different types of boxes, in the next class, in the next lesson, we will learn how to trade each kind of box. Which option trades, which stocks, how to pick them, which option trade is better for which type of box. One thing I want to mention is, as I mentioned, markets are fractals. The 50 MA on the daily corresponds approximately to the 9 MA on the weekly. Similar way, the 50 MA on the hourly corresponds approximately to 9 MA on the daily. So when you're looking at a 9 MA box on the daily, that's a 50 MA box on the hourly. So you can look at it that way, and if multiple time frames have a point in one direction, we'll make a decision in that direction. Buy. All right, that's enough for this class. The next class, we'll see how to trade each kind of boxes. See you then.